Okay, Professor Jim Schultz here from my Finance 513 students. I wanted to go ahead and shoot a video here that kind of accompanies the information you're reading about in Chapter 4, reading about the Federal Reserve and monetary policy and all the different things that they're doing. And I thought it would be very timely to go ahead and record a little lecture here about quantitative easing, or QE. You read a little bit about that in Chapter 4, but I wanted to expand on that and give you guys a little bit more depth and detail as to what QE is, what it started, or I'm sorry, when it started, what it is trying to accomplish, and we are actually here as of June 2014. We are near the end of QE, and so I kind of wanted to talk about some of the consequences and implications behind kind of being at the end of QE. And so, give me just a second here. So let's go ahead and get started. Let's talk first about the Federal Reserve has what is called a dual mandate, which basically means this. It is trying to accomplish two simultaneous goals at the same time. It is trying to not only bring the economy to full employment, that would be its first, the first side of the dual mandate, but it's also trying to promote policies that will bring about price stability. And so let's talk briefly about both of those, each one of those things. So full employment, we could argue all day as to, what is full employment? Is full employment 4%, unemployment 4.5%, 5%, 5.5%, whatever, right? A lot of economists will argue or debate about what level actually equates to full employment. But we can all agree that in 2008, when the financial, we had just gotten through the housing market crash, and then the financial market meltdown hits, and unemployment nationally was like 9, 9.5%, 10%. And so everyone can agree that that is simply too high. That is not anywhere near full employment. Now we're, I'm not sure exactly where it is. I think it's around 6.5%, 6 to 6.5%. It might be like 6.2, I want to say. We're probably still not there yet. We probably still have a little ways to go. But that's the first side of the dual mandate that the Fed is tasked to try to figure out, to be honest with you guys. The second side is price stability. And price stability basically means the Fed is going to try to closely monitor the money supply in the economy so as to allow prices to gradually rise over time. That is the optimal scenario for economic prosperity from the eyes or through the lens of the Federal Reserve. They generally target around a 2% inflation rate. If they're around 2% inflation year over year, then they will feel like they're accomplishing their price stability objective. Okay? Now, as we're going to see as we move down to the interest rate changes and money supply targeting and whatnot, oftentimes these two sides of the dual mandate cannot be accomplished simultaneously. And so sometimes they're mutually exclusive. Sometimes you have to focus on one at the expense of the other. And many people would argue that what the Fed did starting in November 2008 with quantitative easing was solely aimed at full employment and put us at great risk of having runaway inflation at some point in the future. And we haven't had it yet. Well, we may have it later on. I'm not sure. We may have it at some future date. But we have not had runaway inflation yet. And so far, it's, whether or not it's been successful, we'll get into in a minute. But I just want you guys to understand right now that these two things are typically mutually exclusive. Okay, so interest rate changes. So oftentimes what the Fed has different tools at its disposal in terms of what it can do to try to alter employment levels, to try to promote better price stability. And the purpose of this video is not to go over all those tools. You read about a lot of those tools in Chapter 4. I want to focus on one of those tools, and that's basically going to be interest rate changes. The Federal Reserve basically controls the Fed funds rate and the discount rate, which you read about in Chapter 4. When the Fed changes those rates at the very top, that will have a trickle down effect throughout the economy that will, in essence, end up impacting all interest rates throughout the economy. And depending on when you had me for 311 or 680, or if you had me for 311, I know you had me for 680 if you had 680 at Winthrop. I may have talked about this somewhat in the bond lecture. It's possible. Some semesters I'm able to get into it, other semesters I'm not. It all depends on the flow of the class and how much time we have. And so some of this obviously will be somewhat of a repeat of what you may have already heard me say, but much of it is going to be new. So maybe some of you have heard about this trickle-down effect before, but just in case you haven't, just understand the Fed, through the money supply, can target its primary two rates, the Fed funds rate and the discount rate. And when those rates change, all other rates in the economy change. And they change in the same direction, right? And so, for instance, if the Fed decides it wants to decrease the Fed funds rate, then what's going to happen is once that takes hold, all other rates in the economy are going to follow that interest rate decrease at the very top, all right? Okay, so how does the Fed change interest rates? How does the Fed alter its Fed funds rate, for example? Well, it's going to do that by targeting the money supply. Okay, and here's basically how it works. So suppose that the economy was too slow, right? Which is the exact scenario that the Fed was faced with in 2008. So here's what the Fed basically does. The Federal Reserve will start to call up banks and government security dealers and these financial institutions, and it will basically call up these financial institutions and say, hey, we want to buy all your bonds. Okay? We are going to exert a tremendous amount of demand pressure for your bonds. So what happens? The actual transaction is the Fed obtains the bonds, puts them on their balance sheet, and in return, obviously, the Federal Reserve gives those financial institutions a lot of cash. Okay? So you essentially have two very important effects happening at once. Number one, banks get a lot of cash on their balance sheet, cash that they can do things with. But secondly, and more importantly, you have learned before in Finance 680 or in Finance 311, you have learned that when interest rates change, bond prices change, right? So for instance, if interest rates go down, bond prices go up. You guys already know that, right? Well, okay, well here's an interesting parallel to that. The other side of that cause and effect is also true. If bond prices change, interest rates change. So in essence, that's exactly what the Federal Reserve is doing. When the economy is slow, the Federal Reserve can put a bunch of demand pressure on bond prices by wanting to buy a bunch of bonds. That demand pressure is going to lift bond prices. Think back to economics, right? When the demand of something increases, its price increases. So the Federal Reserve exerts a bunch of demand on bond prices, causing their prices to inflate, which in turn causes interest rates to fall. So by the Federal Reserve increasing the money supply, by wanting to buy all these bonds, interest rates end up falling. And specifically at the top, it's the Fed funds rate that ends up going down, and then that trickle-down effect takes hold. Now, why is this important? Well, this is important because, think about it, right? When interest rates economy-wide start to fall, what is going to be the impact on consumers? Well, basically what happens is money itself becomes less expensive. Money becomes cheap when interest rates are low. Think about it, right? Ceteris paribus, if the interest rate on a house is low, you as a consumer are more likely to buy a house. If the interest rate on a car loan is low, you as a consumer are more likely to buy a car. And so on and so forth, all the way down the road, from student loans to credit cards to personal loans to home improvement loans, all these different things, right? So money becomes cheaper, which causes consumers to spend, and in the United States, we as an economy are 70% driven by the consumer. For our economy to prosper and flourish, we need the consumer to spend money. Period. End of discussion. Right? And so the Federal Reserve knows that. So by targeting the money supply and increasing the money supply, they can cause interest rates to fall, which causes money to become cheaper, which causes consumers to spend more money. Now, what if the economy is growing too quickly? Well, if the economy is growing too quickly, then what happens is the Federal Reserve will do the exact opposite. It will essentially sell bonds to banks, suck up their cash, decrease the money supply, increase the Fed funds rate, and cause money to be more expensive. Now, you may be asking, well, why would the Federal Reserve ever want to do that? Don't we want to keep growing? Don't we want to? Wouldn't money being cheap always be a good thing? Not necessarily, and that's because of that other side of the dual mandate, that price stability, right? When you have too many dollars in the system, when there's too much money floating around, think again back to economics, supply and demand. When the increase of when there's an increase in the supply of money, it is eventually going to cause the value of money to go down, right? And so now all of a sudden the value of money is decreasing, which could lead to runaway inflation, which could lead to prices rising, which could lead to a lot of chaotic and catastrophic events. And so it's very much a balancing act. The Federal Reserve does not want the economy growing too quickly because that could be very problematic in the long term. So, that brings us to the end of QE. So QE started in November 2008, and it has gone through several rounds, right? The Federal Reserve first came out and said, all right, we're going to buy a few $100 billion worth of bonds from banks. Okay, that wasn't enough. And then a couple years later, they bought more. And then a couple years later, they decided, okay, we're going to stop doing lump sums. We're going to do a regular, recurring, monthly purchase of like $85 billion worth of bonds in the economy. Now what is happening, and this happened a few months ago, is Janet Yellen, the chairwoman of the Federal Reserve now, her predecessor was Ben Bernanke. They decided that it was time to start tapering that program. So now we're down to, I think it's some 45 billion or 55 billion. Sometimes I forget, a billion here, a billion there. At the end, it kind of doesn't even matter. But we're tapering that bond repurchase program. And so eventually, quantitative easing is going to come to an end. And it looks like it could happen this year. Or some economists predict this year. The Fed itself has said next year, but you never know because things change. And the Federal Reserve, a lot of times they deliver on what they say, but sometimes they don't. And so economists kind of go back and forth. So the question is this. The end of QE, is that going to be good or bad for the economy? Well, I'm going to give you guys a couple of things to think about. Here's at least one reason why it's very good. The only reason why the Fed would stop QE is because they see a healthy economy. They see a growing economy. That's the only reason why they would stop QE, right? They feel like we, the United States, finally has our act together. We're finally growing. We finally repaired most of the damage from the recent recession that started in 2008, and we are on the right track. So the Federal Reserve does not feel the need to have this monetary policy in place to make money so cheap and increase the money supply so drastically. So that's good. That's terrific. Long term, that's really, really positive because that means that we're growing, we're back on track, and all those things. But many investors, many people are very, very, very concerned about the end of QE. And this is why many people think this is bad. Because when money is cheap, it's kind of like a sugar high in the stock market. Everybody gets excited, everybody gets, they get happy, and that typically sends stock market prices soaring, as you have seen over the last 5 years. The stock market, since the beginning of QE approximately, the stock market has just absolutely gone bonkers. I mean, it has been a very strong bull run over these last 5 years. And so many people see the end of cheap money, and they see potentially a stock market collapse. They see potentially a stock market crash. As money becomes more expensive, the economy will naturally begin to contract as money becomes more expensive, and the stock market could take a serious hit as a result of that. And so many people see the end of QE as being a very negative thing. And here's another thing, and I'll end with this. What a lot of people don't realize is end of QE or no end of QE, here's what essentially needs to happen. The Federal Reserve has purchased all these bonds, right? So on their balance sheet, they have all these bonds that they do not essentially want to hold until maturity. So what does that mean? Well, when they went to buy all those bonds, that put upward pressure on bond prices, which in turn led to falling interest rates. Well, what happens when the Fed has to clean up its balance sheet? When it has to shrink its balance sheet a little bit and get rid of some of this debt? Well, if it decides to do that and not wait until these bonds mature, it's going to have to go into the open marketplace and sell all these bonds, which is going to put downward pressure on bond prices and upward pressure on interest rates, which could get really nasty really fast. And so that's what a lot of people are concerned about. People are concerned that not only can money not stay cheap forever, but when the time comes that it starts becoming more expensive, it may start to accelerate very quickly, and we may find ourselves in a collapse. And so that's a little bit about QE. I know that's a lot of information, so you may need to listen to this a couple of times, but I really hope that was helpful. I think that's a nice, detailed, in-depth discussion that really accompanies what you guys are learning in Chapter 4.